Hi, it's Bob Oupsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder and CEO of Advisor Perspectives. Advisors and their clients need to manage pressures they have not seen for 20 years: market volatility, inflation, rising rates, and potentially higher taxes. With fixed income not holding up as a low risk part of the portfolio, it's time to look at other strategies to protect client portfolios. Steve Scanlon is head of individual retirement for Equitable and a member of its operating committee. In that role, he drives the strategy for the individual retirement business, including distribution, product, inforce portfolio, M&A, capital, and strategic relationships. Steve, I know you've been a guest on this podcast before, and actually I'll include a link to our previous podcast in the notes that accompany this one. But tell us a little bit about your career path and what led you to your role leading the individual retirement business at Equitable.
Thanks. First of all, thanks for having me. It's great to see you again. Appreciate the opportunity. So, my background has always been in the investment business. It's been sort of a diverse career, I guess I would say. I started off a long time ago working for a company that wholesaled annuities through broker dealers. So I really got my start in the annuity business back in the mid '90s, and that parlayed into a career where I moved to AllianceBernstein and moved to New York City in 2003 to take over their insurance sub-advised business and build that out. And then AB moved me around a lot. I ran built their defined contribution business and then ran their private client business in the Southwest. I moved back to Texas in 2009. And then in 2014, I founded a startup, which was basically built on creating transparency for clients and advisors to have better discussions. And then in 2017, I came back into this business with Equitable running the group retirement business. And then last April was asked to head up our individual retirement business. So I've really spent a lot of time in the annuity business and a lot of time in the asset management business, which has been a good mix, I think, for what I'm doing now.
Well, as I noted in my introduction, advisors are helping clients navigate a market environment with some pressures that we really haven't seen in 20 years. Bonds don't create the kind of safety within a portfolio that they once did. What strategies can advisors use to help invest through this period?
Yeah, I mean, I think you make a great point. I mean, even an experienced advisor, right? Think about somebody that's been 10, 15 years in the business has never seen this. And so to your point, if you had and we use this a lot, and it's probably a little antiquated, but a 60-40 portfolio, the 40 was there to protect the 60, and that doesn't work anymore, to your point. So what we're seeing is people look really in the alternative space, both for protection and for income. And I would very much place annuities or protection as an asset class of its own in the alternative space, meaning that if you're looking for ways to attack the predators that are out there now, taxes, inflation, rising interest rates, volatile market, that's what annuities were created to do. And so we're seeing a lot of advisors now say, hey, I've got to make sure my clients are protected, but I can't, maybe my clients are retired, but their money can't retire, right? So I've got to make sure they're still they still participate in the upside, but have downside protection. And that's what this industry and what Equitable was founded on. It was providing this kind of protection and tax protected growth for clients.
Well, I like to think that I'm being helpful to the government when I pay my taxes, but I think you're right. It's really a predatory analogy. Annuities are sometimes thought of as one size fits all products. To what degree is that still the case, or in what ways have they evolved?
It's not the case really at all anymore. And that's industry wide, right? So if you think about it, Equitable invented the two biggest parts of the variable annuity space: the guaranteed income space and the RILA category, which is this buffered equity participation solution. 15 years ago, it was probably true that you had to, even if you didn't want a death benefit, the only way you could get the living benefit is by having a death benefit. Now it's really, for the most part, bifurcated, meaning if you just want, inexpensive tax deferred growth, that's the, investment only variable annuity space now, of which we participate in. If you want to buy just the protection on the downside, you can do that, right, through the RILA category. If you want just income, we created a product last November, where you can actually just come in and get, a buffered strategy on the upside, and just get and pay for guaranteed income if that's the only thing that you want. So I like to think about our business now as we work with advisors in a very similar fashion to how they work with their clients, right? We sit down and we talk about the individual client need, and then we can customize a solution around that. So it's one of the biggest things that aha moments for advisors that haven't looked at annuities in years. And I've seen this myself several times, where they'll say, I wish you could just do this, or could you do that? And I'm like, yeah, we've been able to do that for 10 years. They just haven't looked at annuities in so long. And we're really encouraging them to come back and take a second look now, because the annuity business has evolved considerably in the past 10 to 15 years.
What types of clients will benefit the most from the kind of protection that annuities offer?
So it varies, right? We are seeing, for the first time, not the first time, but the first time in a while, I guess, even younger people who typically had looked at annuities in a long time, but just, they funded their 401k, they funded their IRA, they've got other money earmarked for retirement, and they're putting money away in something that's just inexpensive, and they can get tax deferred growth. So I like to think about it as like a private retirement account, right? Certainly people in retirement have always benefited, in my view, from the protection that annuities give. But again, what we're seeing now is high net worth people coming in and saying, I've still got to protect my coupon, if you will, my income. I can't get it in bonds anymore because rates have risen and it's really hurt the bond market. Can I just come in and buy something where I've got a guaranteed income stream? And that is newer, because it used to be they didn't want the death benefit, like I said earlier, and they just wanted the living benefit. And now we've been able to basically say, what is it that you're looking for? So it's anywhere from younger people, which is a new one for us, or newer, and then all the way up to high net worth people that are just needing to make sure they protect their income, and literally everything in between. And again, I think you're seeing people really starting to understand that bonds can go down, right? It's been a long time since people have really understood that, I can lose money in bonds. It's really been fascinating for a lot. Like people just didn't know that, just didn't really understand that you could ever lose money in bonds and their income could be affected. So a lot of fixed income investors are coming here. And then clearly people that are just worried about the market. I mean, one of the biggest tools that annuities provide for advisors, and by proxy their clients, is enabling them to invest appropriately with feeling protected. Meaning, I want to be invested a lot less in equities because I'm scared, but I can't because I have longevity risk and all these other things. So advisors use annuities to get clients appropriately allocated to equities, but also help them feel good.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day, so why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Fowl for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member, and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. So you mentioned bonds can go down, and we've certainly seen that this year. We've got a stock market that is flirting with bear market territory, been down quite a bit in the last week. We're recording this today on September 29th. Rates are headed up north of 4%. Given that climate, is it advantageous time to buy an annuity?
Yeah, I mean, this is sort of the perfect storm for why annuities were built, right? So if you go back to when I started in the business, annuities were all about outpacing inflation, not having to pay taxes until you were ready, and a death benefit. And they've come all the way into what I consider now a very critical part of asset allocation. So now those things, like you mentioned at the beginning, Bob, that rates, we haven't talked about rates going up in 2 decades. We haven't talked about inflation in 2 decades. Now that's coming back into fold. So all of these, it's kind of like what's old is new again. All these things we used to talk about back in the 90s have come back, with a vengeance. And you have, bonds creating losses, and obviously stock market volatility. And all the while, people are living a lot longer. So the stats. I mean, 10,000 people a day are turning 65. People are retiring, and they have to make sure that they're protected through retirement. So this is as good of an environment for what we solve for as any I've ever seen.
Well, the other concern that advisors and clients have around rising rates is that they're going to eat away from the income that a variable annuity provides. What's your response to that?
Variable annuities are obviously subjected to market moves, but the guarantees within the variable annuities are not. So it's almost like you have 2 ledgers. You've got your account value that's moving up and down like it does, but you also have your guarantee that I can always rely on this. I mean, what we do that no other solution does is we tell you worst case scenario, you're going to get this. And people know going in exactly what they're going to get. So it won't erode the guarantee. It can certainly, nip away at the account value. But as we know, over time, staying in the market has provided long-term positive results for clients. I think what the guarantee does is it gives people the willpower, if you will, to stay invested, knowing that they're at least going to get, a certain amount of guarantee. And that guarantee is very attractive to people.
Aside from that guarantee, what else should advisors and their clients consider when they think about adding an annuity to a portfolio?
So here's what I would say. If you think about an asset allocation model, right? And that's really what advisors do is they customize asset allocation models based around the needs and wants of their clients. Think about all the things that we've talked about, right? So I've got, taxes, I've got inflation, I have rising rates, I have volatility, I've got all this uncertainty out there. If you had one investment vehicle that could actually solve for those things, it is an annuity. So our strong, feeling is that advisors need to take a look at this as adding protection as an asset class. And the protection that you're providing is based on whatever the customer is most worried about, right? It could be protection from paying taxes every year. It could be protection from volatility. And so that's why we come in and say, if you use the annuity as a sleeve, just like you would maybe international, or you would, S&P, participation, I think that's what people need to be looking at in terms of variable annuities. It's an alternative asset class, in my view, that provides protection against all of these, as I said earlier, predators that are out there now.
What other allocation changes should clients be thinking about in the context of making a commitment to an annuity within a portfolio?
Well, I think it's a matter of, so some people look at it as I want to have exposure to international as an example, but I'm worried about the international markets, but my advisor wants me to have a global portfolio. So we see people that'll come in and say, can I buy the IFA, right? The international index with downside protection? And the answer is yes. So you can globalize a portfolio with comfort of knowing that you're protected on the downside, as an example. You can clearly do that with the S&P as well. We see a lot of people that are moving out of fixed income and into the guaranteed income products that we provide because they're not getting the income, and bonds, as we've talked about, are exposed right now. So I've got to protect my income. So people are using it and saying, I had a 60-40 portfolio. Now I'm going to go 60% equities, 20% bonds, and 20% annuity with a guarantee to protect that income. But the beauty of it is you can actually change from an advisor standpoint. And remember, I spent a lot of years in the asset management business. From an advisor perspective, you can change what you need the annuity for. In other words, you can start out as, I want to just shield my client from paying taxes every year like I do in a mutual fund. But it could morph into, now this client really is worried about income. And now you can just turn on the income guarantee. You know what I mean? Like you can actually just say, that's what I think is lost on, candidly, on a lot of advisors and certainly clients, is that it can be bought for something now, but you can change your mind and still have that sleeve in there that's now providing a different level of protection. And that's pretty invaluable to an advisor, quite frankly.
If there's one key takeaway that you would like to leave with our audience of advisors about how they should position annuities to clients in this market environment, what would that be?
So I think it would be a summary of what we talked about this whole podcast, which was effectively just saying that there are things that, how you started off, there are things that we have not seen in 2 decades. And there are, like inflation, like rising rates, right? There are also things that we haven't seen since the credit crisis, which is significant volatility in the markets, right? All of those things combined are concerning to all of us, right? And really concerning to clients, particularly those that are relying on a certain amount of income in retirement. There isn't another vehicle or solution out there that actually can go address all of these predators other than an annuity. And I think it's really important for people to understand. And again, we don't, we will give people partial protection on the downside, right? So we don't, we give them partial protection on the downside to make sure that they're going to be protected to a certain level, but they get, X amount of upside. We'll give them guaranteed income that they can't get even in fixed income. We will help them outpace inflation by giving them opportunities to invest in equities, with also the understanding that they're going to be partially protected on the downside. My overall message to the advisor community is, if you haven't looked at annuities in a long time as an asset allocation model or sleeve of your portfolio, there's never been a better time. And you will be shocked if you haven't looked at an annuity in a decade at how far we've come.
Well, we're going to leave some contact information so people can look at annuities and the suite that Equitable offers. We'll include a link to the Equitable website that points to its variable annuity offerings. I'll also include a link, as I mentioned, to the podcast that I previously did with Steve. Steve, is there anything else you'd like to add?
I just want to thank you again for your time, and we look forward to sitting down and helping find solutions for clients, as we always have in our 160-year history.
Well, you're welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Steve Scanlon of Equitable. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.